Joining us on the show today is Mish Schneider, Chief Strategist at Market Gauge. She produces her Mish's daily notes for free on the website marketgauge.com, which all of you can access and follow. So Mish, if I look at the stock market on the day that you and I are speaking, it is Thursday. A lot of volatility that we've seen for this half of the year. If you look, basically we topped out around July. And it's been kind of up and down since. There's been a lot of talk on our show, and I know in your notes about pre-election volatility and some of the uncertainties that are, of course, going to keep investors a bit confused on which way policy may go after November, of course. But you were writing in one of your recent notes how we have seen somewhat of a historic turnaround in the market and that buyers appear to be stepping in. So tell us, what's your big picture view on the U.S. stock market here?
Well, yeah, so we'll start with what you just said and work backwards. So this week, coming into this week, when people were getting really super negative in the market for a whole host of reasons, we had something we haven't seen since the bottom in October 2022, which was the NASDAQ start out, I think, 1.6% lower and then close 1.7% higher. And forgive me if those aren't exactly accurate in terms of the percentages, but you get the point. And so really what happened was that a bunch of buying started to come into the market. We can talk about all the different reasons why, but probably if we just step back, the main reason is that NVIDIA started to see more buying coming in. And of course, that's been like the pinnacle of everything, but not necessarily sustainable. And we can get to that. And secondly, is that it's pretty, I think, obvious at this point that although we have seen somewhat of an economic slowdown from our peak, that's very different than going into a recession. And it doesn't look like we're going into a recession. And so I think people realized that there was a lot of areas that probably presented with much better value than they did before. And let's look at NVIDIA. I mean, NVIDIA had gone down to 100. I was kind of hoping it would go to like 85, 90. And then, it took off and trading up around 120. Now, do I think that that's going to new all-time high soon? No, but it's just reflective of how willing people still think that technology and AI is going to carry everything. So getting back from a economic standpoint, people were looking at the debate to present some kind of clarity in terms of where we might go economically in a new administration or a new old administration. And instead, what we got was a lot of politics and not a lot of economics. And so essentially what this is all looking like to me is exactly what, when I've talked to Jim through the years, is that stagflation environment. And so really what does that mean is that this was a great rally, but that doesn't mean we're necessarily going to go to new highs. And if we do, they may not be sustainable because at the same time, as the economy has slowed, labor, not recessionary, but slowed, some of the manufacturing slowed, prices have come down in certain things, but on others, it's actually starting to look now like inflation could be bottomed and we could start picking up, which is something that happened in the late 70s after everybody thought inflation was over. Then it almost looks like a mirror image.
Yeah, it's very interesting because if you do overlay a chart of the inflation figures that we saw during the 1970s with what we've seen so far, there is somewhat of an eerie similarity. And if we were to track that analog moving forward into the back half of this decade, that would argue that we're going to see a big pickup in inflation. History doesn't repeat exactly, sometimes rhymes. So maybe that is a good thing to keep in mind of what we could see. But on the day that you and I are speaking, we are seeing a big pickup in the commodity complex and especially gold. And, again, drawing to that analogy of what we saw during the 70s, precious metals did very well, especially gold. Commodities did well, and the stock market was kind of volatile in a trading range. In what ways do you think we could see some of those things play out again?
We actually, in some ways, it's more insidious now than it was back then. I mean, life was simpler all around. Before you and I actually got into the recording, you mentioned modern monetary policy, and that is that it doesn't matter how much you raise the debt, you can basically just print your way out of it. So what does that mean going back is that our debt is much higher than it was in the late 70s. The dollar has many more vulnerabilities than it did in the 70s. BRICS is a real thing. even though it's been faked out so many times where it looked like you were going to get some kind of an organized movement to devalue the dollar or at least price certain goods in the dollar. It hasn't quite happened yet. The presence of countries that are joining BRICS has increased way more than what we saw in the 70s. The geopolitical stakes seem to be much higher now than they were in the 70s. And at the same time, we also have other reasons to look at inflation that may not necessarily be, to use that same word, insidious in terms of just inflation running amok because of debt and spending and Fed misstep on policy, but also because of the real demand that we're getting from AI and the fact that that will require a tremendous amount of raw materials to keep going if the projections that you're hearing on what's going to happen with these data centers is true. It's going to only increase another 20-30% over the next few years, which requires water, natural gas, silver, copper, materials that we know are not infinite in supply, but more finite. And so even if you think technology will eventually also be able to produce these materials and we won't need them anymore, that's not going to happen for many, many years. That's a utopian type of feeling, but not reality as we know it right now.
Oh, absolutely. And that was something that was borne out in a number of different books that have come out. I would say in recent years, talking about just the raw material inputs that go into our modern digital economy. As you know, there has been this myth, maybe on the green side or many on the environmental side, in saying that as we move towards a more renewable green future, well, we're going to need less of oil and critical materials. And what we're starting to learn, like you pointed out, is no, actually they require tons of different critical materials, including rare earths, which largely come from China, and all sorts of different things, including electricity, right? I mean, these data centers require lots and lots of electricity. Like you said, natural gas is one of the main things for that, nuclear energy. So lots of things that go into this. And what's fascinating is, if you think about that 70s period, again, the markets moved in a sideways, volatile fashion. Commodities outperformed. They were a good place to be. Precious metals, of course, did very well. And we see precious metals outperforming the U.S. stock market year to date. So that's a pretty astonishing fact. And, it sounds like, given your view, as you said, you're looking at more of a slowdown, but not a recession. We've already seen the manufacturing part of the economy in contraction and recession for 2 years. So we're not even growing on the manufacturing side. The global economy is seeing a contraction now. What happens when all of a sudden we start seeing that growth come back? Like you said, if we don't see a recession, we start moving back into growth. What does that mean for the commodity complex?
Well, yeah, that's why it seems like no matter what picture you want to paint, commodities look really attractive. And, I think what we have to look at, not besides the technology sector, but in terms of whether or not we're in stagflation and this is a speed bump to recession, which of course we can't dismiss that possibility either. As we know, the way you get rid of hyperinflation is to create a recession. That's exactly what happened at the end of the inflationary period in the 70s into the early 80s. But we have to look at the consumer, because what we're seeing, and I know the word bifurcated now has probably become the new word and very overused word, but it happens to be an incredibly good word, because if we look at the slowdowns that you just mentioned, that's real. But at the same time, if you look at the consumer, there are many, many different areas you can look at for the consumer. If you're going to look at the consumer in terms of the lowest strata of the economic levels, obviously the Dollar Generals and the Dollar Trees, they have not done well. Those stocks really got killed, and some of the discretionary stocks. But at the same time, if you look at the staples, which would be more middle class and even high middle class, and not the 1%, obviously, those have done amazingly well with highs in Walmart and Costco and Target and TJ Maxx. So essentially, it's going to be up to the consumer, I think, and how resilient they continue to be, that will determine whether or not we stay stagflationary or we go into major recession. And so I think what's great is we can talk theory all day long, but what I am is a student of what to watch. So if you will, allow me a couple of minutes here to say, how will we know? So let's talk about the inflation part of the stagflation right now. I have what I call my trifecta of factors, right? To really gauge whether or not inflation is just going to pick up or if we're going into some kind of a new super cycle. One would be, well, the dollar affects everything, of course, but we've seen periods of inflation where the dollar hasn't done very much. But if the dollar obviously crashes, we can add that to our trifecta. So, but going back to the actual trifecta, one would be silver to gold. So yes, gold is rallying like crazy and most likely will go to 3,000. This is something that, we've predicted, and I've been on this show over the last few years talking about. Looks like it's happening, but it's how silver responds to the gold. That ratio, that's going to be really important. That's the true sign of inflation, is when silver begins to outperform. And there are many reasons why that could happen, not the least of which is what we just talked about with technology. Gold is rallying because it's like our mirror that we're putting up, and it's reflecting all the cracks everywhere. And it's saying, not so fast, market, because, there are problems everywhere. So that's number one. Number two, and also kind of in line with number one, would be the gold miners, which, by the way, as we're talking, are up 4% today. They haven't even started yet. And gold miners, of course, are going to be really important because A, inflation, B, technology usage, including copper is a part of that, which is also rallying today, not as much. But there are some other metals that are mined, and that you would see reflected in the miners that would actually not only benefit from increasing technology, but spell out inflation. The second thing, of course, would be oil. And oil has been such a political football right now, highly manipulated, it seems. And a lot of the reasons why people think oil is not necessarily over $80 a barrel and actually broke briefly $70 a barrel, now is flirting with it again, is because of China. And China is doing everything in its power right now to stimulate its economy back. So if that's the case, if oil gets back over 80, it doesn't even have to go over 100. If it just gets and stays more expensive, inflationary. And the third thing is something that very, very few people, if any, talk about, but it's not just the grains market, which also look like they bottom, but it's the sugar market. And sugar, the reason why that's my third trifecta is, number one, in 1979, well, actually in 1976, sugar went up to 64 cents a pound or 66 cents a pound, came all the way back down. And then in 79, it went up to about 45 cents a pound. Didn't quite go back to new highs, but it had a parabolic move. Why is that inflationary? Because sugar is in everything. I mean, it's just in everything. So it means that the cost of all foods will go up with the price of sugar that goes up. And as much as people say sugar is so bad for you, it's still something that people, especially in poorer countries, rely on. And right now that's trading at around 19.5 cents a pound. We've had a series of lower highs since we peaked. The last swing high was at $20.19 a pound. If it takes that out, then we break that pattern, and I think that would be another sign. So those are real things to look for in terms of the inflation part. In terms of the actual economy part, like I said, you want to watch retail, obviously, 70% of the GDP. But you also want to watch that relationship with the long bonds and the junk bonds, which has really remained risk on because the junk bonds have so outperformed the long bonds right now. If that flips and gold starts falling, that would point to me that, okay, stagflation didn't really balloon as much as we thought, and instead, like I said, became more of a speed bump to recession. But that, I don't see any signs of that happening yet.
Okay. Yeah. And the picture that you're painting, it sounds like, and tell me if you think that this is an accurate characterization. If we were to see recession, we can't rule that out completely, of course. If we were to see that materialize, then of course we could see more downside on the inflation stats. The most recent figure was 2.5%, down from 2.9%. That was for the month of August, that 2.5 number. If we did see a recession, of course, we could see inflation fall even further. But if we do see more of a slowdown, as the data is suggesting currently, if that persists, and then eventually that leads to an uptick from, again, the 2-year recession we've seen in the manufacturing sector, and we do see a lot of the stimulus, both on the US side and on the China side for their economy, which has not been doing well. If we start to see that lead to a pickup in growth, well, then inflation is going to come back up. That's going to be putting pressure on the Fed again. We're going to see commodities increase again, and that's going to be putting pressure on the markets. And so, again, depending on how things play out here, it sounds like the Fed is going to be dealing with potentially a very difficult environment where, essentially we're at higher than average inflationary levels if we don't go into that recession. Commodities are going to constantly being that inflationary force once we come out of this slowdown in the manufacturing economy that we see both in US, China, and abroad. That could be this stagflationary sort of tricky place that we'll be in for the years ahead. In which case, what we're doing here is we are trying to stay more neutral on the stock market, have a higher exposure to those inflationary hedges, precious metals, certain commodities, but keeping in mind that you're going to probably need to be a little bit more active for this decade than what we saw in the bull markets in the past. What would you say to that as a sort of big picture view of how we could see things unfold?
100%. I mean, absolutely. This is the pickle, as we've called it, for the Fed. It's happening. We're seeing it happen. And regardless, I mean, obviously, other than full-blown recession, which of course would not be good, the other part of what we're looking at, regardless of who wins, is that both candidates are very much committed to reshoring, bringing business more and more back into the U.S., spending more money on infrastructure, from everything from alt energy and tech and EVs to also creating space for manufacturing, with this, talking about giving incentives to companies that produce here, et cetera, et cetera. That's why it's hard to really present a recessionary case, because it's almost like we're going to stay stagflationary, maybe go back into period of growth, which also would be inflationary. The other thing you mentioned is the active trading, and I think that was also a really good point. I've always been an active trader. I was born in the commodities exchange, which was all about active trading, so that's kind of like my whole nature and our company's nature. Market Gauge is we do active trading with risk controls, etc. But the only thing I want to add to that is part of that is because I do believe the retail space that really increased after COVID coming into the market has gotten a little bit smarter and is taking profits on big moves and buying massive dips when they look like it's stopped. So if the whole universe of trading has gotten smarter, that means in order for you to compete, you have to think actively. That doesn't mean that you shouldn't have maybe a basket of certain really safety plays. Fixed income obviously has been something really good, or stocks that you collect dividends on. But for the most part, most people aren't necessarily looking at that. They're looking for the quick money. They're looking for the NVIDIA money. They're looking for the meme stock money. And that's really been self-fulfilling in terms of trading more actively.
Yeah, I want to go back to the comments you made about the debate. Notably absent from the debate was any focus on out-of-control spending or on tackling the U.S. debt. I mean, this used to be a pretty key focus of candidates in the past of, hey, we've got to do something about this debt. Neither candidate seems to be very concerned about that anymore. Of course, Harris did bring up the whole Goldman Sachs report that had projected that deficits would see a bigger increase if his policies were implemented versus hers. But I think regardless, either candidate, we're going to see deficit spending maintain the level. That's what the Nonpartisan Congressional Budget Office is projecting, just when you look at Social Security, demographic factors, spending on defense, interest expense, all of those structural issues argue for increased deficit spending in the years ahead. So the amazing thing about that is, and this was just updated, so I'm looking at real-time stats right now on the Fiscal Data Treasury website. This is the government's website. They say, and the question is right at the top of the website, how much has the U.S. government spent this year? The U.S. government has spent, I'm reading right off the website again, 6.29 trillion fiscal year 2024 to ensure the well-being of the people of the United States. And it shows that that is 14% more spending than 2023. And again, we're seeing this level of spending in the context of what most would say we're not in a recession, right? We haven't been in a recession. The manufacturing side of the economy is in a recession, but we're not seeing that with the services and the retail side, as you pointed out. And yet we're spending this amount of money right now. Again, what does this line up for? Stagflation.
Absolutely. And here's so interesting is that, and this is why my theme this week is do not invest based on politics, invest based on economics. And instead of looking at the differences of the two candidates, I've been really focused on the commonalities. The debate really made that crystal clear, not so much in like what you just said, what they did say, but what they didn't say. Both candidates promise to spend a lot of money. They have to because they're not going to be popular. In fact, I can't even remember the last president who said, well, sorry, but we're going to have to cut. We're going to have to cut. And we're going to have to tax, and look what happened. The only president that I can remember who actually really did that and was a one-term president was the first Bush, who ran his campaign on read my lips, no new taxes. You see, I'm old enough to remember all this stuff. Maybe you're not, but
oh, I am.
But then he raised taxes because he actually tried to be fiscally responsible, and he didn't get reelected, even though maybe he was one of our better presidents we've ever had, because what happened even with the war, he ended that so quick with very little collateral damage. So my point is that the presidency is no longer about sound economic policies or sound geopolitical policies. It's more a popularity contest, populism. That's what's taken over the whole world, right?
Yep,
and
yep.
we're no exception here. And so if you look at it from that point of view, they're both going to spend money. They're both going to spend money on defense because, God forbid, the United States, which has the biggest military above all the militaries all around the world, that doesn't matter. We have to be bigger. We have to be stronger. The Americans have to feel secure. And especially, day after September 11th, which I worked in the World Trade Center for 14 years, people say never forget. They don't. They never want to be caught like that again. In terms of the social services, there may be threats by Republicans more than Democrats on cutting back on Medicare and Social Security. Ain't going to happen. Not going to happen. They're just not going to happen. It's going to be so unpopular because, we have to take care of the people who have put their lifetime of service into the economy by working and paying taxes, and Social Security and Medicare are the two ways to do that. More spending money. Geopolitics, they're both going to spend money on supporting the causes that they want to support, whether Trump believes that he could end the Ukraine war, which I don't think he can, but that doesn't matter. Whatever it is, if he's talking about more tariffs, that's a mistake. Then he talks about less tariffs, because really the bottom line is both candidates will do whatever's popular. So those are the commonalities, is neither one talked about lowering the debt or really cutting back on the spending, because they can't to win. And then once they are in either one of them, they'll maintain that to stay popular and keep their party popular. That's basically what it's become here. That's the reality of the situation. But all of these things still continue to point to inflation and stagflation. And they both also want to bring, like I said before, manufacturing into the U.S. They both want to see cannabis legalized. I think that's something interesting to watch. And they both also, in terms of talking about cryptocurrency, have been relatively pro cryptocurrency, which is a whole other area we're already involved, and I am personally, and then also have put clients into, not Bitcoin itself, because you need to have your own individual wallet, but into some of the cryptocurrency technology like blockchain. So I think these are all the commonalities, and that's what you have to keep your eye on if you want to make a longer term investment, or even if you want to continue to trade more actively.
Well, those are great thoughts there, Mish. And again, I think a really big point here is when you're talking about this largely debated topic of recession, when we look at just the amount of spending that's coming from the federal government, the amount of stimulus that's being injected into the markets and economy each and every year, 6.2 trillion, 14% higher than last year. Well, we're spending the amounts that you would typically see within the bottom of a recession or within the midst of some type of financial panic or emergency. We're doing that when we're not in a recession. So that seems to argue that, if there is any slowdown from here, the downside is probably limited. And the upside for inflation, once we do come out of this slowdown, is probably higher than what a lot of the market anticipates. And with the lack of investing that we've seen into the commodity complex, the lack of capital moving there because of all the pressure from ESG, towards, really focusing on renewable energy, the myth that it exists in many people's minds that, we don't need materials anymore. That stuff's, that's the past. There's probably going to be a bit of a wake-up call, and maybe gold is sending that signal as we speak.
Yeah, and I'll add two things to what you just said. Not only are we spending like we're at the bottom of a recessionary cycle, but we're ready to start cutting rates like we're at the bottom of a recessionary cycle. So you add that to the mix, and absolutely, all of this looks very much like we're heading in that direction. Yeah, I think you said it perfectly, but that's really the theme in terms of investing, and people have I have had arguments myself, healthy ones, with people who are trying to convince me that we're disinflationary and we're going to be deflationary, and that the Fed really accomplished their job, and everything that you and I just mentioned really points to the absolute opposite direction. And again, what we haven't talked about in all of that is the dollar, which is probably more in the headlines now than I can remember it for a very long time, except when it gets like uber strong. And then of course, then it starts hitting headlines. But right now it's pretty low. And if it breaks down DXY under 100, that's going to have a whole other impact. So the dollar will go down like we're at the bottom of a recession, when really we're not, which will only be more inflationary. The other thing I wanted to talk about with the candidates is everybody thought that when Biden became president, that there would be oil and gas would completely dump, and EVs and alternative energy would fly, and just the opposite happened, right? So we have obviously had this big move in oil and gas, even though it's come down a little bit from the highs, and we had a tremendous sell-off in EVs and solar energy and wind energy. And so that's another area, by the way, that I don't think that you can say, if the Republicans win, it's drill, baby, drill, and it's going to be oil and gas and forget all energy. And if the Democrats win, oil is going to now really go down, and it's going to break below $65 a barrel, and it's going down to $30 a barrel, and all energy is going to go up. I think either candidate right now, whoever wins, the writing's on the wall. We need all energy, whatever it is, and nuclear, of course, is now being talked about more and more, clean nuclear energy, to be able to power the technology of this country and of the world.
Yeah, I would agree. And China, by the way, is doing that. India is doing that. They're plowing heavily into not just renewable energy, but also coal. They're still firing all cylinders there to make sure that, of course, they want to have cheap electricity, cheap energy. And so they are using all hands-on approach, nuclear, coal, solar, you name it. They're plowing forward across the board. We are trying to do something different, but raw materials are still needed in today's economy. And I think that we're going to be seeing that more and more assert itself over the years ahead, especially as, like you pointed out, I mean, we're continuing to see this massive build out of data centers. Those do require quite a number of different critical metals and raw materials that many people just are perhaps not putting enough importance on when you think about the electrification of the modern global economy moving forward in the years ahead. Mish, I really appreciate you coming on and giving us your thoughts on the market and economic outlook, your macro view on a number of these different things. Again, as I mentioned at the very beginning, you produce Mish's Daily for free on your website. So that's something that all of our listeners can take advantage. What would be the best way for them to do so?
Yeah, well, before I answer that, I just want to say one thing that's maybe a little edgy in terms of what she and China is doing and what we're doing in the US in terms of alternative energy and really moving forward to a clean space as opposed to drill, baby, drill. And it has a lot to do with politics and lobbyists, where China may not necessarily be so worried about the lobbyist factor. We are here in this country. So that's something also to not forget. I just wanted to add that. Since politics is so much in the air right now. But anyway, in terms of reaching me, as you mentioned, yeah, I write a free daily, and I kind of theme it. So depending on what you are interested in, Monday I do a technical outlook. Tuesday I do what's turning around. Wednesday it's like the hump day. What do we look at for the rest of the week? And then Friday I sort of recap and give you expectations for the following week. And I do that all as a way to give to the community. We also have an asset management company. It's called MGAM LLC. We do a lot of quant trading, but we do have a discretionary component that I do. And of course, we have a lot of tools and things that help the actual trader trade better as part of our Market Gauge suite of products. So that's something if anybody's interested in looking at. We do a lot of webinars. And of course, just like this wonderful conversation I had with you today, I do a lot of media appearances and I get to talk to a lot of super smart people about the nature of things in the world, politics and the economy and the market.
Well, once again, we've been speaking with Mish Schneider, Chief Strategist at Market Gauge. The website is marketgauge.com. Mish, such a pleasure to have you on the show. We look forward to speak with you in the months ahead.
Thank you so much for having me. It was such a great pleasure to be here today. Thank you.
That